Klarna, the Swedish fintech giant, continues to expand its user base to 100 million active customers globally. However, its financial health tells a concerning story. Klarna's net losses more than doubled to $99 million in the first quarter of 2025, significantly worse than the $47 million reported a year earlier. This dramatic decline follows a devastating 85% valuation slash, plummeting from $45.6 billion in 2021 to just $6.7 billion. Despite generating record revenues of $701 million, Klarna faces mounting challenges that threaten its sustainability. The company's growing credit losses hit $136 million in Q1 2025, a 17% increase from the previous year. These troubling figures suggest fundamental flaws in the company's business model, especially as reports indicate users are increasingly failing to repay their loans. Founded in 2005 in Stockholm, Sweden, Klarna began with a simple yet revolutionary idea to bridge the uncertainty between consumers and merchants through short-term, interest-free credit. Initially called Creditor, the company rebranded to Klarna in 2010 and rapidly emerged as a pioneer in the payment services industry. Klarna's approach to payments transformed online shopping by offering flexible payment options without charging interest. In 2024, an impressive 99% of transactions conducted through Klarna's network were interest-free. This consumer-friendly model helped the company achieve remarkable market penetration, particularly in Sweden, where approximately 82% of adults used Klarna's services in 2024. The company's innovative payment solutions allowed consumers to split purchases into manageable installments, effectively creating a more accessible shopping experience for millions. After establishing dominance in the Nordic countries, Klarna expanded across Europe, entering Germany and the Netherlands by 2010, followed by Austria, Switzerland, and the UK. The company's strategic pivot came in 2015 when it launched in the United States. By 2019, Klarna had made the US market its principal focus for future growth, securing exclusive partnerships with luxury retailers like Macy's. Investors initially flocked to Klarna, fueling its meteoric rise. In 2019, the company raised $460 million, valuing it at $5.5 billion. Subsequently, Klarna's valuation skyrocketed, ultimately peaking at $45.6 billion in June 2021, following a $639 million fundraising round led by SoftBank Group's Vision Fund 2. During this period, Klarna emerged as Europe's most valuable private tech company. This extraordinary growth trajectory positioned Klarna as a global powerhouse, serving over 675,000 merchants across 26 countries and processing approximately $80 billion in online sales by 2021. In a bold strategic pivot, Klarna abandoned traditional customer service in favor of artificial intelligence, a decision that ultimately backfired. In January 2024, Klarna launched an AI assistant built in collaboration with OpenAI, rapidly scaling it across 23 global markets. The company boasted impressive metrics. The chatbot handled 2.3 million conversations, approximately 2/3 of all customer service inquiries, in its first month alone. Moreover, Klarna claimed the AI system performed the work of 700 full-time agents, reducing query resolution times from 11 minutes to under 2 minutes. CEO Sebastian Siemiatkowski proudly projected a $40 million profit improvement for 2024 through this initiative. The reality proved starkly different. Customer satisfaction plummeted as users encountered generic responses and inadequate problem-solving. By early 2025, Klarna faced a mounting wave of complaints about the AI system's inability to handle nuanced inquiries. In a surprising reversal, Klarna began rehiring human agents, first through a small pilot program with flexible, remote workers. Klarna aggressively showcased its AI capabilities to bolster its tech credentials and operational efficiency metrics ahead of going public. This approach temporarily boosted key financial indicators. Average annual revenue per employee jumped from $400,000 to $700,000, but ultimately damaged customer trust and brand reputation at a critical juncture in the company's history. Klarna's troubles represent just the tip of the iceberg for an industry built on shaky foundations. The BNPL business model fundamentally relies on extending credit to consumers with limited ability to repay. Nearly 41% of BNPL users admit to making late payments, undermining the industry's financial stability. Additionally, default rates continue climbing as consumer debt reaches unprecedented levels, recently hitting $18.2 trillion in the US. Most concerning, approximately 2/3 of BNPL applicants fall into subprime or deep subprime categories, yet 78% still receive approval from lenders. Moreover, user complaints also revealed operational problems. Many customers reported payments being taken from their bank accounts but not showing up in their Klarna account history, creating confusion and frustration that undermined trust in the platform. The BNPL space has become exceedingly crowded, with major financial institutions like Apple and PayPal launching competing services. Its customer acquisition costs have skyrocketed while profit margins shrink. Simultaneously, consumers show growing wariness of accumulating multiple BNPL commitments across different platforms. For younger demographics specifically, BNPL now constitutes 28% of all non-secured borrowing, an unsustainable level that suggests market oversaturation. Regulators worldwide have begun scrutinizing BNPL practices. The UK Financial Conduct Authority recently mandated stricter affordability checks, while US regulators are finalizing similar oversight. So I hope you guys enjoy this video. Leave your thoughts in the comments section below. Hit the subscribe button and like this video for more such content.